We have achieved an 11% profit in just 11 days investing in the stock market, and in this video I'll explain to you how I have done so. Before we dive into that, real quickly, welcome to another episode in my Value Investing Model Portfolio series, where I'm investing real money with the purpose of building up a track record over time. Today is the 13th episode and we'll get right into it with first, the 11% profit explained. So I would like to preface this chapter by saying that this 11% profit in 11 days was achieved on about a 15% portfolio allocation. That is to say, this wasn't just on a tiny part of the portfolio, this actually matters. Now, the company that has allowed us to achieve this impressive return is Gannett, a company you might have never heard of before. Gannett is basically a media powerhouse. They have multiple brands under which they publish print journalism as well as online news articles. If you are American, you might have heard of some of their brands like USA Today or some of their local publications like the Arizona Republic. And really, that is where the company shines. They publish news articles under a metric shitton of sub-brands, which all operate in very small local niches. I believe is the competitive advantage of Gannett. Because the company is so freaking large, they benefit from some cool economic phenomena like economies of scale and economies of scope. But because the company also operates in so many small niches, they also have the benefits of a small company. So this structure allows Gannett the best of both worlds. The efficiency gains of being large, but the nimbleness and the positives of niches of smaller companies. Really cool. So that is Gannett's business. It is boring, it has moats, and it has room to grow by going digital. But that is of course a very small part of the investment equation. Another part is the balance sheet. And this one isn't so hot. I mean, the liquidity is fine, meaning the company has enough cash and cash equivalents to keep their business operational on the short term. But what I'm personally worried about is this: their debt position. So during Q1 2023, the company in total had $1.235 billion in debt outstanding. That is quite a lot for a company which only earns about $50 million on an earnings basis in a good year. Thankfully, the management team has recognized this over leverage, and that is where another part of the good stuff stems from. You see, since 2019, the company paid down significant parts of their debt. Back then, the company had almost $1.8 billion of debt outstanding, which they got down to just $1.2 billion today. And it seems that the company continues to head down this track of debt repayments. Of course, if the management team is successful in doing so, the company will be significantly more healthy heading into the future. So that is the second part of the investment equation, the balance sheet. And it isn't too hot on the short term, but significant shareholder returns could stem from this source in the form of debt repayments, which deleverages the company, hence higher multiples on the stock market in the future. Now, the last part of the investment equation, which by the way is heavily simplified for this video, well, the last part is this: the guidance of $85 million to $105 million in free cash flow during 2023. On the high end, this is 62 cents in free cash flow per share, and on the low end, this is 50 cents in free cash flow per share. If we compare that to the current share price, that puts Gannett at a free cash flow multiple of 3.41 to 4.24. Not bad at all. Actually, that gives us investors a current free cash flow yield of about 23% to 29%. And remember, that is compared to the current share price. When I bought Gannett, it was for about $1.9 per share. Now, of course, management guidance should always be taken with a grain of salt. Anyways, that is why I decided to buy a significant stake in Gannett between the last update and this one. Summarized: 1. An insane free cash flow yield of about 23 to 29%, which should give us investors an insane return. 2. While the debt position is worrisome, if management succeeds in paying it off, it could also give us investors a really good return as the company de-risks itself. 3. The business Gannett is operating in, news articles, is boring AF, which is why we like it. Now, will I buy more of Gannet? Well, the technicals tell me that a cool-off period might come soon. Moreover, as 17% of the portfolio is already invested in Gannet, I do not need to buy more. Don't get me wrong, I would love to buy more Gannet, but I have no rush to chase this stock. I can be a patient investor. I can be a patient hunter, waiting for an attractive entry from both the technical and the fundamental side. Now, I think we have talked about Gannet enough specifically. Real quickly, before I compare my performance against the S&P 500, here is a screenshot of all transactions made between the last update and this one. And of course, this is how the portfolio currently looks like, with all the stocks listed here and their amounts held in the portfolio listed here. Yes, we have a negative cash balance, so we are using margin. I used this margin to buy Gannet, and I am expecting a cash deposit at the end of this month, which should cover this margin position. So that is why. Now let's talk about the comparison. And holy, we are getting destroyed. I'm down 1% compared to holding cash, and I'm therefore underperforming the S&P 500 with about 4% at this moment in time. I don't know if we will ever emotionally recover from this. Jokes aside, thankfully, due to how this portfolio is structured, I have no one breathing down my neck. There is literally no reason why I should be performing well on the short term, as all my goals are long-term goals. I remain confident that all the stocks we picked in this portfolio will perform well on the long term. Even the two biggest detractors, Base Resources and Clearfield, I continue to add towards. Yes, being down 25% on one position and 20% on the other sucks, but it is part of investing, and especially part of value investing. I gave this analogy to my dad recently. The whole purpose of value investing is looking for smoke in the cinemas. Which theater room has the most smoke without actually containing any fire? Smoke will clear, short-term noise will clear. Of course, we do not want to purchase a literal shitfest on fire. So that is the tough part. Is this downward trajectory on Clearfield permanent? Is the theater room literally on fire? Or is there just a lot of smoke in the theater room because there's a fat kid in the back vaping? I believe it's the latter, hence why 36% of this portfolio is invested in Clearfield. If and when Clearfield starts to recover, bet yo ass we will be overperforming the S&P 500 again. And that's about all I have for you guys today, so now time for a classic YouTuber disclaimer. While I am a registered financial advisor in the Netherlands, I do not have the legal capacity yet to give anyone investment advice. Therefore, this video and any other video on this YouTube channel can never be taken as financial advice. I cannot be held liable for the losses you make while trading according to my opinions. Please do your own due diligence. And with that said, thank you so much for watching. I love you all. Peace.